Welcome to this explainer where we're uncovering a massive financial blind spot. We're diving deep into some fascinating behavioral finance insights today to show you why mastering your money is actually less about crunching numbers and, well, entirely about understanding the quirks of the human brain. We all kind of default to thinking of wealth as pure math, right? But today we're exploring what's really driving your wallet, your savings, and ultimately your financial future. And spoiler alert, it is definitely not the calculator app on your phone.
Okay, let's just dive right in. Picture this. You wake up tomorrow and you find out you've suddenly inherited exactly $1 million. I mean, on paper, that's the magic number. Mathematically speaking, it should secure your future forever. You punch it into a retirement calculator, set up a standard safe withdrawal rate, maybe allocate it across a few low-cost index funds, and boom, you are completely set for life. The math is absolutely flawless. It's clean, it's irrefutable, right? Well, not exactly. And this is where the Willy Finance analysis highlights a pretty terrifying paradox that completely shatters that illusion. Time and time again, people who come into sudden wealth evaporate their fortunes in record time. 3 years. 3 years, and it's literally all gone. So why does that happen? Because going broke in 3 years doesn't happen from a bad calculator. It happens from unchecked emotions, hidden biases, and psychological traps that completely hijack our logic the very second real money's on the line. When the stakes are real, the rational brain just kind of shuts off, and the emotional brain absolutely takes the wheel. Let's take a look at how wealth is technically supposed to work. You move from a zero-balance survival mode into consistent savings, then you start riding the wave of compound interest, all the way up to building a massive generational empire. I mean, it looks like a perfectly logical staircase. You just take it one step at a time, it's clean, it's mathematical, and frankly, looking at it, it seems incredibly easy. You just follow the flowchart, put the money in the right buckets, and let time do the heavy lifting. But, and this is a huge but, as behavioral analysis from Wealth Logic proves, the spreadsheet lies. Or rather, the spreadsheet fails spectacularly out in the real world because it completely ignores human psychology. Think about it. A spreadsheet never panic sells during a market dip just because it read a scary headline, right? It doesn't get tempted by a flashy new car, and it never, ever gets exhausted by the daily grind of budgeting. The spreadsheet assumes you're a perfectly rational robot, totally devoid of fear, greed, or burnout. And humans are, well, we're anything but robots. Notice the intense clash here between a purely logical move and our deeply emotional need for safety. Think about that classic financial debate. Do you pay off low-interest debt early, or do you invest that extra cash for a higher yield? No, the math is literally screaming at you to invest for maximum yield. But what does the brain actually crave? Peace of mind. The fact that people consistently choose Dave Ramsey's debt payoff method over strictly mathematical investing just proves a core truth. Emotional comfort usually trumps compound interest. The sheer relief of being debt-free is a psychological reward that a slightly higher investment return honestly just can't match for most of us. And you know, this emotional desire for safety is exactly why your standard savings account might secretly be making you poorer. Mathematically speaking, leaving all your cash in an account yielding 0% is a guaranteed loss in purchasing power thanks to inflation. You're actually losing money every single day it just sits there. Yet, what do? We cling to it. We hoard cash because seeing the absolute certainty of that balance, it just feels secure. We basically choose the illusion of safety over the reality of slowly draining our actual wealth. And without even realizing it, we fall victim to behavioral traps exactly like this all the time. Take Nobel laureate Richard Thaler's brilliant concept of mental accounting. This is where we essentially trick ourselves into categorizing money based on subjective, emotional criteria rather than its absolute value. It's the reason why you might enthusiastically blow a $2,000 tax refund on a vacation because you view it as a windfall, like free money, but you'd fiercely protect $2,000 you saved up from your weekly paycheck. It's the exact same amount of money. But your brain slaps a totally different label on it, and that leads to some wildly irrational choices.
And this brilliantly illustrates why we so often sabotage our own net worth. The groundbreaking work of Kahneman and Tversky on prospect theory introduces this concept of loss aversion. Get this, our brains are literally hardwired to feel the pain of losing $100 twice as intensely as the joy of finding $100. No way, right? But this fear paralyzes us. It's the psychological reason we hold on to losing investments way too long, just blindly hoping they bounce back so we don't have to admit defeat. And it's also exactly why we sell winning investments entirely too early just to lock in a safe win, which completely derails logical market math. All right, let's look at how all this plays out in the real world with the Gen X case study, a true paradox of wealth. So folks born roughly between 1965 and 1980, Gen X, they exhibit behaviors that absolutely baffle traditional financial advisors. I mean, they treat credit card debt like it's a deadly trap, yet they heavily stockpile cash savings instead of investing it all. And because they're deeply suspicious of what we'd call traditional financial security, they quietly build backup incomes, start side hustles, and aggressively DIY their financial plans. But here's the kicker. Despite all this protective hoarding and intense suspicion, they are surprisingly willing to splurge on big life experiences. Their logic? No economic recession can ever repossess a memory. When we actually map this out, the generational contrast is pretty striking. While other demographics might operate on, say, general optimism, trusting standard market returns, or maybe they rely heavily on debt, Gen X runs on a completely different core emotion. They're driven by suspicion and a really fierce need for independence. Having lived through multiple economic downturns and the dot-com bust, their emotional baseline of trusting practically nothing dictates an entirely different, incredibly resilient, and highly customized financial roadmap. And frankly, a standard optimistic spreadsheet could never predict or fully understand it.
Now, an outside observer might quickly label this as a harmful scarcity mindset, but psychology tells a totally different story. What looks like scarcity is actually a documented psychological strategy called defensive pessimism. It's been researched heavily by experts like Julie Norum. Basically, it's the act of intentionally lowering your expectations to prepare for the absolute worst-case scenario. Gen X actively uses the anxiety of a financial doomsday as fuel to ensure they are drastically overprepared. So the emotion isn't a weakness or a bug here, it's a built-in feature and it's actually their primary wealth-building tool. So, where does that actually leave us? Well, whether you're climbing the corporate ladder, trying to be the first millionaire in your family, or building a generational dynasty, you can't just rely on one extreme. Ascending the levels of wealth requires acknowledging that a purely mathematical approach is just going to crack under the pressure of human panic. Conversely, a purely emotional approach, that just leads to irrational hoarding and zero growth. You absolutely must balance both. You need a financial plan that works on the math for sure, but just as importantly, it has to deeply respect your emotional bandwidth. And this brings us to a truth that perfectly captures the essence of our explainer today. Money feels emotional, even when the math is simple. Ultimately, true progression through every single level of wealth requires a major mindset shift. Building an empire is just as much about mastering your own mind, understanding your hidden behavioral biases, and managing your anxieties as it is about mastering the stock market, calculating compound interest, or playing the real estate game. So before you look at your next payslip, review your retirement plan, or judge your own spending habits, I want you to ask yourself a vital question. Are you managing your money, or are your unexamined emotions managing you? What hidden emotional habit is silently directing your bank account right now? Take some real time to figure that out because that self-awareness, well, that's the true first step to unlocking your ultimate financial potential.